This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 102.5 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans. Or you can talk to him right now at 407-916-5400.
Good morning, ladies and gentlemen. Welcome to the program Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and you're listening to News Radio 102.5 WFLA. On the program this morning, we are going to share with you perhaps one of the very worst outcomes we've ever seen involving planning your estate. More specifically, how to deal with a 401k or 403b. And the specific story we're going to tell today, it involved a 403b, but the same concept applies to 401k. So make sure you listen in on that one. Also on the program, I think a couple of weeks ago, we talked about the new tax form coming out, 2018 tax form. So our CPA at the office decided to run a comparison and of what someone's income was in 2017 and then what the tax result would be in 2018. We've got some interesting numbers to share with you on that. We will, of course, recap the week that was as well and look ahead to the week ahead in the market. But we also wanted to do some follow-up on a couple of questions that we got after the show last week when we were talking about some estate planning stuff, some good topics. So we want to certainly share with you the questions that other listeners asked offline through the email. Of course, you can ask us whatever you'd like and add your topic to our daily conversation or today's conversation. Not daily. We don't do this radio show quite that frequently. It's weekly. But you can do that by simply calling in 407-916-5400, 1-855-545-1025. That's how you can call on in and add your topic to our list for today's program. Or you can send us an email. That email is my first name, Joel, Joel, at Nelson, Nelson, financialplanning.com. So that's how you can get in touch with us and add in your topic. So we had a couple of follow-up questions. The first one says, to reduce probate, we filed a quitclaim deed that will leave our house to our kids in case my wife and I both die. We are also beneficiaries on all our accounts. I missed the first 15 minutes of your program, so you may have covered this. This email was from Peter. And yes, in fact, naming the kids as beneficiaries on your house is a great way to avoid probate. Generally referred to as a an enhanced life estate or a ladybird deed, where you and your spouse remain the owners, but then when you pass, it goes directly to the named beneficiaries without having to go through probate. It is a superior approach to a regular life estate because a regular life estate, if you are trying to sell the house, guess what? You have to have all of the beneficiaries sign off on it. If you are trying to mortgage the house or get a line of credit on it, you have to have all of the beneficiaries sign off on it. That's why a life estate can be quite cumbersome, because legally, the people that you have named as beneficiaries have a legal right now to that house. An enhanced life estate, otherwise known as a ladybird deed, retains 100% ownership in your names. And so ultimately, that's really the best way to go, because that allows you to retain ownership while at the same time naming kids or beneficiaries directly as beneficiaries when you pass. Almost like putting a transfer on death on that account. So certainly a good option. Peter also, if you recall, was the one that called into the radio program, or maybe sent an email. I forget which, but he was the one that was looking at doing an IRA conversion to a Roth, and he actually had a follow-up on that because he continued to work the numbers on it, and it did turn out as we suspected. So before, the IRA conversion to Roth turned out to be worse than I originally calculated, because he had calculated at hey, I'm in the 12% bracket, so it's not only going to cost me 12%. We brought up the issue of you may very well trigger additional tax on your Social Security when you do that, because that extra income is going to trigger more of your Social Security getting added into the mix. And that is, in fact, what happened. As Peter was saying in his email, very little of our combined Social Security income is currently taxable. So to convert $40,000, we're essentially paying 21% on this money and not 12%. It's a tougher decision, and need to consider future tax rates and taxable Social Security rules. They're not going to change that one, by the way, because that's a nice moneymaker. Or when my wife and I die and have to use single tax tables. But yes, the point is, it's not just 12, it's 21. And at 21%, that may just give you pause to do it, because as you use that IRA account, you're only taking, a little bit of money out every year, right? You're not just, you're not taking a larger lump sum out. If you're taking 5, 6, 7,000 out, you're still able to maintain closer to that 12% rate. If you go really high like this 40,000, then ultimately you wind up almost doubling the applicable return. So interesting question from Peter. Make sure that, of course, you understand the full tax ramifications before you do that. And as that email properly points out, the Ladybird Deed Enhanced Life Estate is a great option to avoiding probate. Similarly, got an email from Greg with another question about revocable living trust. Can a successor trustee change the beneficiaries after he assumes control of the estate? That's a fascinating question. And it appears that as Greg's been running it by his advisors, he's getting different answers. So my Florida attorney says yes, whereas my attorney up north says no. My accountant up north also says no. So we've basically got a version of the Civil War almost, where the people in the north are saying no and the people in the south are saying yes. My logic would dictate that a successor trustee cannot make a beneficiary change. I would appreciate your opinion. So we responded to Greg, and unfortunately, we're in the South, so we're on the side of the Florida attorney. And here's the nuance of it. Okay, a successor trustee of a revocable living trust can, in fact, make changes to the trust if the language of the trust allows for amendments and refers to trustees in general, and does not make a specific exclusion of the successor trustees. That's very specific, but the question is, Can the successor trustee change the trust? The answer is yes. Under these circumstances, the trust amendment provisions is left generally to trustees and not specifically excluding successor trustees. Now, here's the caveat. A successor trustee on a revocable living trust could only make changes if the person who set up the trust, the grantor, is in fact still living. Because once the grantor dies, the person who set up the trust dies, the trust then becomes irrevocable and no changes are permitted. So you see the difference of opinion that Greg was experiencing with his advisors was really a function of what facts, in fact, we were talking about. Greg also had a follow-up question on a joint ownership of a house. And if joint ownership, if one dies, does that avoid probate? Yes, it does. Same comments that we made with Peter. The reality is that an enhanced life estate or a ladybird deed also accomplishes that quite nicely when, in fact, both joint owners on a property pass away. We're going to slide to the break because I really want to have some extra time in the next segment to really devote some time to what very well may be the worst, or certainly the worst outcome that we've seen in many years from the failure to roll over a 401k or a 403b. And on a side note, the crummy advice that you can wind up getting from a 1-800 number. We'll return here on Dollars and Cents. This is Joel Garris on News Radio 102.5 WFLA.
Hettinger, you know you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Okay, let's set up the story and give some details on this. There will be two conclusions at the end. Number one, always roll your 401k, 403b over to an IRA. And number two, be very careful about the advice that you get on 1-800 numbers, no matter how convincing it might be. So, this lady, age, let's say 85, I'm going to change some of the numbers here to not give too much away. 85, her husband dies 5, 6, 7 years ago. And he had in this case, it was a 403b. So she, of course, was the primary beneficiary. And at the time, the company that the 403b was with said, oh, you're on such a great platform. You really should just leave it there. Okay, we'll just set it up as a beneficiary type of account. And then that way you get to stay on that same platform because, we don't do that platform anymore. And that's just so much better. And the platform that gives you options and all that kind of stuff from an investment side. Problem is that the advice that she got all those years ago did not take into account the implications of the required minimum distribution. Because, see, what happens is the required minimum distribution is calculated based upon life expectancy tables set forth by the IRS. The IRS basically has three. There's one, which is your traditional required minimum distribution table for those of you who are over age 70. There's another one called the single life expectancy table, which is if I am a beneficiary of an account. And then there's a third one, which you have to use if your spouse is 10 years younger than you. So when you set up a beneficiary account, you force yourself into the single life table. Well, here's the thing about the single life table that would apply to a beneficiary. It accelerates the distributions at a much, much faster pace. In fact, almost double or triple, particularly when you get on up into your 80s. So this woman, trying to do the right thing, inherited, her husband passed, calls the 1-800 line. Oh, it's such a great platform. You can't get this platform. It's just so low in the expenses. And it's, oh, my goodness, it's just, you got to stay right there. Okay, so she stays right there. Without anybody bothering to explain that since she herself was already in her 80s, that she would have to take out about triple the amount of money every year than if she had put it into an IRA in her name and had the regular required minimum distribution tables apply. Because, see, as a spouse, you have a very special exception. You, when your husband or wife pass away, get to treat that account as your own. That then becomes almost like you funded that retirement account personally. And then that means, because it's now yours, that you don't have to follow the single life tables that you would if you were just a regular beneficiary on an account, but rather you can follow the required minimum distribution over age 70 and a half life expectancy table. You can get to use a different table that doesn't require you to take out, in this person's case, triple the amount of money that you would have otherwise had to take out. All of that, by the way, is fully taxable. A bunch of income will triple the amount of income that this lady did not really need. So she has a massive tax bill every year. She's paying more for her Medicare, and the implications are tremendous. All she had to do was move it over to an IRA. So if you don't want to put your spouse in a position of making the wrong decision, why don't you take that 401k and that 403b that's hanging out there and roll it over to an IRA now? Don't put them in that position, because the story gets much, much worse. Grandmother, her son had passed away, leaving grandson the beneficiary now of this account. So grandson, who's 40, now thinking that it's going to be an inherited IRA, a beneficiary IRA for the grandson, who's 40, could immediately then jump over to the single life expectancy tables and reduce that distribution down to like a tenth of what's currently coming out of the account. The rest of the account then continues to remain invested, continues to grow on a tax-deferred basis, becomes an incredibly powerful asset for the rest of this 40-year-old's grandson's life. Except that because the grandmother was convinced by the 800 number to leave it right where it was, it wound up getting set up as a beneficiary account rather than a spousal rollover to their own IRA. So now, guess what? The grandson has to keep up the same distribution schedule as what the 85-year-old grandmother was on. So guess that means that the huge sum of money in this IRA now basically has to be taken out by the grandson over the next 6 or 7 years rather than over the next 50 years. Start to run the numbers on that, start to run what that looks like over time. Holy mackerel. That's big. Perhaps one of the worst outcomes that we've seen, maybe ever, based upon the advice given to set up a beneficiary IRA as a spouse rather than to roll it over into your own account. You've got to be thinking through all of these iterations and how poorly it played out, not just for her. I mean, she was taking out triple the amount of money that she would have had to have taken out had she been under the normal tables that would have applied to her as somebody that's over 70 and a half. But now it gets even worse for the grandson because the grandson now has to take out a huge sum of taxable money over the next 6 or 7 years, where if it had been done the right way by the grandmother, it would have been over the next 50 years. Start to run the numbers on a tax-deferred account like that. That's tremendous. 2 conclusions. We'll repeat them again. Do not leave your 401k or your 403b sitting. Roll it over to an IRA. Look, the argument that the 1-800 numbers love to do on their 401k and 403b, say, oh, my goodness, the platform, it's just so much cheaper. You're going to save a little bit of money. Blah, blah, blah. I'll tell you what, you don't save anything. Whatever savings was there are gone by the tax implications of the move. Roll it over so that you don't create a massive tax issue and you preserve the option to have that money continue on a tax-deferred basis for the next generation. This is particularly true if you're married, you've got a spouse, you want to leave the money to the kids or grandkids. My goodness. So if you don't do anything out of the program, learn that. And then be careful of the advice you get on an 800 number. They do not provide tax advice, and they don't know what they're talking about. Because that's a little bit of a finely tuned analysis that comes with years and years of experience working with people on a face-to-face basis, not answering calls on a 1-800 call center in a booth next to 50 other people. Doesn't work. Be careful. We'll slide to a break. When we get back from the break, we will continue the conversation. We will see what the numbers look like on 18 versus 17. Here's an interesting one. So stay tuned for that because we've run some tax numbers looking ahead to the tax changes that will, in fact, apply for your 2018 tax return. So stay tuned for that. We'll also take your calls as to additional topics you'd like us to hit this morning, 407-916-5400, or shoot us an email at joel@nelsonfinancialplanning.com.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. This is your host, Joel Garris of Nelson Financial Planning. If you missed that last segment, I would encourage you to catch it again on either our website or our various social media outlets. You can find us on any of those places: iTunes, YouTube, Facebook, blah. List goes on and on when you're talking about social media. But I think when I look at our signature, my signature block these days is like 10 different little mini picture icons underneath it that you can click on and find us, pretty much everywhere. Google Play, LinkedIn, any of that. Anyway, if you missed it, you can catch it on any of those. We usually post it tomorrow, first thing in the morning. Cannot emphasize the conclusion from that story. You've really got to be careful on these IRAs, particularly when inheriting them. Or let me rephrase that. On any retirement dollars. Because if you don't put it into an IRA and you just leave it and put it in your own name and treat it as a beneficiary, as if you're the spouse, you're really going to mess things up for the next generation. And you're also going to mess things up for yourself because you're going to have a much higher required minimum distribution because now the single life tables apply rather than the regular age 70 and a half life expectancy tables. And then you're really going to mess your beneficiaries up because your beneficiaries, once you start on the single life table as a beneficiary IRA, then your beneficiaries have to continue that same exact distribution schedule. So be very, very careful with that. A few weeks back, we talked about the fact that they had finally rolled out the new 2018 tax forms, or at least a draft version of them. So our good friend CPA Steve Lasula, who does all of the returns in our office, said, I am going to take a return from last year and I'm going to run it through what the new numbers look like. Now, this individual, it was a single female, that doesn't make a difference, single male, single female, whatever it is, a single filer. Since she took the standard deduction, then she doesn't have any issues to worry about there. Well, wait a minute, I was itemizing, so is the standard deduction better or not? Last year she took the standard deduction, and look, let's face it, folks, if you took the standard deduction last year, since the standard deduction just doubled, you're probably taking it this year. High, unless there's been something very odd happening in your life. You're going to take the standard deduction, particularly again this year. Her income was $93,000 in 2017. She paid $16,501 in taxes in 2017. With the same income, running it through the new 2018 tax form, her taxes dropped to $13,894. That's $2,607 less in taxes than what she paid last year. Nearly a 16% savings. Folks, that is huge. And instead of owing like she did last year, $948, she's now going to get a refund of $1,659. That refund, that change, that's significant. And that's a piece that really hasn't worked into the mindset or the overall perspective on what's happening out there in the economy as a whole. So some interesting numbers to share with you on the difference between 2017, 2018. Same person, same income, just ran it again on the 2018, and it's nearly a 16% savings. In this particular case, when this single filer income of $93,000, it's $2,607 less in taxes. Some pretty dramatic numbers when you stop and think about that, for sure. So we had another week, and we got another week in front of us, as is always the case, right? So last week, the headlines were dominated by, obviously, the President Trump and Vladimir Putin election. If you're listening carefully, I did refer to him as President Trump because we did get some feedback on that, so I'm trying to be more conscious. And a continuation of the conversation on tariffs, which seem to be continuing to hit the Shanghai, the Chinese market, much more than ours, because for the week that was, our market was basically flat, up a little bit, but basically flat. There was also some chatter and criticism about the Federal Reserve that made some headlines as well. So the usual potpourri of headlines. As we look ahead to this week, well, frankly, last week, a lot of the conversation about tariffs and the meeting in Helsinki and the Federal Reserve really was offset because of where we are in the calendar. Where we are in the calendar is earnings season. Earnings season just starting out. Only about 15% of the companies announced last week. Interestingly, of those 75 companies out of the S&P 500, and 500 usually thought of as the 500 largest companies in America, so only 75 reported last week. Of those 75, 71 topped their forecast. That's a pretty good ratio, isn't it? So even with expectations that were pretty lofty in terms of what earnings were, particularly based upon the past quarter, where earnings were through the roof, nearly 25%, nearly all, 71 out of 75, based upon last week's earnings expectations for the second quarter, or earnings for the second quarter, beat their forecast. As you might well imagine, then, if earnings season started last week, it really takes full swing this week. So you've got a slew of earnings, slew of companies that are announcing earnings this week. Companies like Facebook, Coca-Cola, Boeing, Northrop Grumman, all of those companies, all Amazon, all of those are all. So it's a big week for earnings this week. Also on Friday, you get a read on the second quarter GDP. Looks like that might not get all the way to 4, but might be very, very close. So stay tuned for all of that. We'll slide to a break. And during the break, we've got open lines and open emails. So if you'd like to add your topic into our conversation, feel free to call us at 407-916-5400. Toll free 1-855-545-1025. And the email Joel, Joel, at NelsonFinancialPlanning.com. We'll be back right after this.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. My name is Joel Garris, and you're listening to Dollars and Cents. Covered a lot of territory on the program. We will cover one more email in this last segment. If you've missed any part of the program, don't hesitate to check us out tomorrow when we post the program on the various social media I encourage you to really listen in on that conversation about why when your spouse passes, you've got to have that money put into an IRA in order to take advantage of better life expectancy tables and factors. Otherwise, you could be really messing up your beneficiaries. And for that matter, messing yourself up by being required to take out a lot more money, because the required distribution tables on a beneficiary account are much greater, meaning you got to take out the money much faster than if you wind up just taking that as your own, and then, which as a spouse you're entitled to do, and then when you pass, your beneficiaries can then use the single life table because that's the one that they have to use. But you don't want to force them into continuing on your distribution schedule based upon you doing or you taking the single life expectancy factor. Here's another email that we got. This one is from Robert, and he's got a question about his brother-in-law who sold the house and had about $500,000 available and was told to invest in a structured note with the notion of get a mortgage, borrow the money, invest in a structured note, and you'll be ahead of the game because the structured note will make more money than what the interest rate is that is causing that applies on the mortgage. I just don't like that, right? I mean, the spread on bond, the yield on bonds and notes, and in today's world, it is not particularly high. Be one thing if you had bond yields at 8% and you were borrowing money at 4%. But guess what? That's not really how it works. Usually your borrowing costs and your bond yields are somewhat close to each other. So in this case, let's assume that there is at least a positive spread. Whatever it is, it's not that big of a spread. And if it is that big of a spread, then there is, of course, much more risk in there than what is getting described to you by the person that is recommending it. Quite a bit more risk. Because if you're getting 6 on a structured note, yeah, there's some risk in there. That's not a riskless proposition. In fact, if the note is set up so that it is reaching for yield, might be more risk in there than you realize. And yes, in fact, that can certainly go down in value, particularly when you look at performance of things like that. So be careful on that. Don't try and reach. And I think that's a general problem that exists in the world today, particularly when you're talking about the bond side or the yield side. According to a recent analysis by Morningstar, nearly 90%, 89% of short-term bond funds out there. Now, understand what a short-term bond fund is. It's intended to be a short-term bond fund, meaning relatively liquid, a little bit better than a money market, but, owning shorter-term debt, like maybe a 90-day or a year or two. Nothing too terribly exciting in terms of when that debt would mature. That's why it's called a short-term bond. But if 90% of the short-term bond funds out there have their portfolios set up about 70% with corporate bonds and investment-grade bonds, that's not really what you would typically expect to see in a short-term bond fund. So be careful of that underlying compensation because the reach for yield is intense, and it's particularly intensive in the investment management world. And so you've got a lot of funds that are not being true, particularly on the bond side these days, that are not being true to their specific investment objective. And it goes back to this conversation about the structured note and the email from Robert about his brother-in-law who sold his house and is I assume he hasn't done it yet. I hope he hasn't done it. But trying to be convinced by a financial advisor to instead of just buying the next house for cash and not having to worry about a mortgage, that, you should invest that and ultimately make more, and that's a good idea. The problem with that is that the spreads are so narrow. And maybe at the end of the day, you could make a spread of, let's give it 1% at best. That's not really worth taking the risk associated with making that investment in the first place, along with the fact that let's be very clear on the best case scenario when you enter retirement. It's to have a fully paid off house. I mean, that shouldn't be a big surprise. If you can enter retirement with a mortgage or without a mortgage, which do you think is the better option? It's without. Because then in retirement, you don't have to feed a mortgage payment. You can use that money to go do fun stuff. So be very, very careful. Well, it goes back to kind of the theme of the show. Be careful on the advice that you get. Because if it's from an 800 number, it may not be as thorough and complete of analysis as what it should be. And sometimes when it comes from a financial advisor, it may not be in your best interest either. Don't chase 1% when you're taking risk and you're incurring debt. You want to enter retirement, if you can, without a mortgage, simply put. Certainly an interesting conversation, always amazing about the range of advice and information that is out there. You would be surprised. Well, you're not, because I share it with you when it does happen on the radio program. But the amount of, I guess, fascinating turns of events that happen along the way. And speaking of turns of events, we actually had an interesting thing happen this past week, which has not really rarely happens. And the more I thought about it, the more I thought, well, you know what? If you were a investor or an individual and you were looking to figure out where you wanted to perhaps, or who you wanted to help with your finances, one thing that you could do, which not many people do, like this individual did, is just show up in the office. It was kind of interesting because literally the gentleman walked in and said, I'm in the area and this is what I'm doing, and I'm walking into offices. And I just happened to, it was early enough in the day where my appointments had not started. And our office manager, Helen, is out on vacation. So I heard him walk on in because my office is kind of right there. And so I got up and said hello. And he said, I'm just walking in and checking out places. And and he said, you would be surprised at the reactions that I get depending upon where I'm walking in. And I said, I would imagine so, because not many people do that. But I found it fascinating that you can get a lot of a read of an organization based upon what the reaction is when you randomly walk in the door, because they're not prepared for that. So I wanted to share that story with you, because if you are out there trying to make these decisions, that's a pretty novel way and a pretty intriguing way to just show up and kick the tires and see how people respond and react. Catch them off guard a little bit. When you schedule and make an appointment, they're ready for you. When you show up, it's a whole nother reaction. It's kind of neat. I thought that was a pretty good strategy. By the way, he is on my calendar for next week with a specific time and date, but I did manage to catch him and have some time to chat with him that morning. So an enjoyable morning conversation, but one that we had not seen. We wanted to share with you. That's kind of a neat, novel strategy out there that I think's got some interesting implications on it as you're choosing from the host of available options out there to get advice from. We will wrap it up and get on out of here. This has been Dollars and Cents. This is Joel Garris, News Radio 1025 WFLA. How have your investments performed over the past 5 years? Do you know? Are you happy with that number? At Nelson Financial Planning, we've been achieving investment results over the past 30 years using actively managed investments that we own personally. This is Joel Garris, and I invite you to review your investment results with us. Visit NelsonFinancialPlanning.com or call us today at 407-629-6477 to set up a conversation to review your investment performance. That's NelsonFinancialPlanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC at FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 1025 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.